Hi and welcome to the latest market update for the quarter ending 30th of June 2025. As always, I'm joined by Steve Garth from Principia Asset Consultants, who's going to share his insights on what drove markets and what was the performance over the last quarter, but also for the entire year. Steve, it'd be fair to say that there's been a lot going on for the last quarter, but the last year, dominated by Donald Trump's probably unfavourable tariffs. We saw markets initially fall, and then he hit the pause button, and we saw markets rebound pretty strongly. How did that impact the Aussie market?
Yeah, Rob, well, you're absolutely right. Quarter dominated by the on again, off again of tariffs. And when we look at the Aussie market here over the financial year, you can certainly see that big fall at the start of April. Now, that happened around the world. Every market fell by around 10%. A week later, on April the 9th, he paused tariffs and said, look, I'll review this in 3 months' time, which is coming up. Yeah. But markets immediately recovered and had an extraordinary run since then. And so overall, you can see that the Aussie market for the quarter is up by 9.5%, which is huge for a quarter. Yeah. And even for the financial year, it's up 13.8%. Keep in mind, Rob, that that's way above the average financial year return that we've got over the last 50 years in the Aussie market. Yeah.
So fantastic results. And we know here in Australia that we're dominated by a few particular sectors or companies. Anything to specifically note there on that front?
Yeah, I think we can't go past without noting CBA, which has had this extraordinary run. It was the second biggest company. It's now the biggest company on the ASX. Yeah. It's gone up by 50% in the last 12 months, and nobody knows why. So what that means when you look at the chart here, of our two largest sectors, banks and mining, banks are up 30%, but that really is all CBA driving that. On the other hand, the miners are negative, as you can see, and that's because our now second biggest company, BHP, is down by 10%, minus 10%. Yeah. And Rio and Fortescue, the other big miners, are also negative. Now that we do know why. Their share price is tied to the price of iron ore, and the biggest consumer of Australia's iron ore is the Chinese property market, and that is not going very well. Hasn't been going very well for a while. So that's really dragged down the returns we get out of mining. So our two biggest sectors are sort of doing quite different things at the moment. Mm-hmm.
But overall, still delivered a pretty fantastic result for the last, like you say, quarter and the last 12 months.
Absolutely.
So a great result in Australia. How about overseas? Has that also played out in international stocks?
So even better overseas. So you can see in the chart here lots of bars going up, but the main one is probably the one on the left, which there's the quarterly return for the developed market index, and there's the annual or the financial year return, up 18.5% over the last 12 months. Now, over the last couple of years, Rob, when we've done this, we've talked about how the US has really been driving returns, and the US is the biggest part of the developed markets. But this time it's much more broad-based. You can see in the chart there, Europe or the Euro, another big part of the developed markets. That's doing even better than the US. And the emerging markets on the right-hand side also up really strongly. They're up 17.5%. Yeah. So they're right in the heels of developed markets. Yeah. So all in all, for a diversified portfolio of Australian and international shares, it's been a stunning quarter and a stunning financial year return.
And there's also been a lot of geopolitical issues going on overseas. You've got the war over in Iran, and has that sort of played any impact on markets in general?
Yeah, towards the end of the quarter, Rob, as we know, the news was dominated by the Israeli and the US bombing of nuclear sites in Iran. And you would normally think that that would have a big impact on the equity market, the stock market. In fact, it had almost no impact on the stock market. Little wobble there for a day or two. Really the only place you saw an impact was in the price of oil. And on the chart we've got here now, you can see oil not been doing very well, by the way, over the course of the year, but you can see that blip in the last bit of the quarter. So oil quickly rose by 10%, but as soon as there was a ceasefire, then oil went back to its pre-bombing. The other line there is gold, and I think people might know that gold has had an extraordinary run. So gold was up 40% for the year. And, you know, gold sort of got a boost during the bombing of Iran because it is seen as a safe haven asset.
Now, I guess there's been a lot of chatter about interest rates and fixed interest and bonds. We saw the RBA hold rates here. There's concerns about global debt levels. What can you share with us in relation to the bond and the fixed interest market?
Yeah, look, that is absolutely right, Rob. So here, yesterday, as you mentioned, our RBA paused rates, which kind of stunned the economists. They were expecting it to fall. But it was only 2 weeks ago that the US also kept their rates on hold, or even though that was expected. So here's the thing. Central banks have sort of got competing forces at the moment. It really is around tariffs, but the extra debt levels that Donald Trump's one big beautiful bill is another $3 trillion to US debt. That's kind of worrying the market a little bit too. So the competing forces are, on the one hand, is that tariffs are potentially inflationary, which would put yields up, which would mean interest rates would have to go up. But on the other hand, the tariffs might also slow the US economy down, and therefore interest rates will have to come down. So they're sort of stuck between the two. Australia's got different forces, but it looks much the same. Overall, however, Rob, when we look at the chart here, in fact, yields have, while they bubble along, they've come down over the year. So all in all, we've had positive returns from the bond market when yields go down, bonds go up. So you can see here that the global bond index, which is what we're showing quarter by quarter, but over the full financial year, that's up by 5.6%. And the Australian bond index, even better than that, up by 6.5%. So way better than sort of 30-day term deposits.
Yeah, excellent. It's great to see. So we've had good returns in equities, we've had good returns in bonds. Despite a bit of volatility, despite a bit of uncertainty, probably wait and see what happens on interest rates from central banks around the world. But it's fair to say that the last quarter and the last year has been a pretty good time.
It's been a fantastic time, and I think it sort of goes to our philosophy as well about keeping in a strategic asset allocation, not reacting to market news. So staying in your portfolio has delivered these fantastic results where if you sort of read everything in the media, you don't know what to do. So staying disciplined is the best way to reach your goals.
Yeah, excellent. Well, thank you again for joining us, Steve, and sharing your thoughts on what's happening with markets. Thank you for joining us today. As always, we're here. If you have any questions or concerns, just pick up the phone and give us a call.